Recession. It's a word we hear thrown around a lot, but what does it really mean? A recession is a significant, prolonged, widespread downturn in economic activity. Historically, it is 2 consecutive quarters of negative GDP growth, or gross domestic product growth. Recessions cause declines in economic output and employment. This has a further effect on unemployment rates, consumer spending, and consumer demand. Are we in a recession right now? This is a very difficult question to answer because recessions are only clearly defined after we've had 2 consecutive quarters of negative GDP growth. However, unfortunately, there are some stark signs that recession is coming for the United States very soon. The first indicator is bank lending. When you look at a Federal Reserve chart from the St. Louis Fed, you will see that banks have tightened their credit lending models and scoring in every recession that we've had going back to the 70s. So as bank lending tightens their standards for credit lending, that's less credit going into the market. That is recessionary in and of itself because it starts to create a liquidity problem. The second factor is that our consumer savings has now retrenched back to the global financial crisis 2008 level, which we have not seen since the GFC. The next factor is our soaring auto delinquencies and credit card delinquencies. In fact, our credit card delinquencies have soared to not seen levels since 2011. The next factor is the labor market. And while we can see big job numbers coming out month after month from the BLS or the Bureau of Labor Statistics, what I can tell you is that overall employment wages are down in January of 2024. So what am I talking about? Yes, we had more jobs added. However, and we even had wage growth per hour. But what employers are doing are cutting hours. They're not willing to let go of their people. They had such a hard time in 2020 rehiring people after they let them go from the pandemic that they're holding on to people. They're raising their hourly pay, but they're giving them less hours. So when you see total compensation go down in a month when 353,000 jobs were added for January of 2024, for example, then you understand that employers are actually cutting back on wages. They're just doing it by giving people less hours. Yield curve inversion. That is a technical term, and you might be saying, what is yield curve inversion, Rebecca? Let me explain it. Normally, when you lock up your capital for a longer period, your rate of return that you would demand would be higher than if you're locking up your capital for a shorter period, like a 1-year CD versus a 30-year bond. I expect my 30-year bond yield is going to be higher than my 1-year CD yield. However, right now, and since July of 2022, our yield curve has been inverted. What this means is that the short-term rates are actually higher than our long-term rates. That right there tells you that something is fundamentally broken. When your economy is expecting that the short term is rougher, they demand more return in the short term than they do in the long term. So this is the market saying something is not right, something is broken. The last time we've had an inversion this long was August of 78 to May of 80. So that is a 21-month cycle. Right now, in February of 2024, we are literally at the point of almost being at the 2-year mark. We'll hit the 2-year mark in June. So we are literally at 20 months. If we go another 2 months, we will have broken the longest inversion period in the history of America, 78 to 80, with this period right now. The yield curve being inverted is a problem. It means that the market is not working as it should and as intended, and it means there is a reckoning that is coming. Inflation for January came in hotter than expected, which only puts more pressure on the Federal Reserve to not cut rates. In January of 2024, Governor Christopher Walser said these are not the financial conditions under which the Federal Reserve would cut rates, meaning if inflation is still problematic and lingering, the Federal Reserve has no ability to go in and cut rates. And so you're seeing the market disrupt again with these inflation numbers because the market realizes that the Federal Reserve will not be able to cut rates anytime soon. The banking liquidity crisis that is coming, that started in spring of last year, March of 2023, most people don't realize 3 of the largest 4 bank failures occurred in the spring of 2023. And they were stopped and stymied and kept down at bay by the Federal Reserve, creating the Bank Term Funding Program, the BTFP. The BTFP is a 1-year program to direct lend to the banks that are having some liquidity and cash flow problems, because a lot of banks have bought treasuries as their ability to hold their collateral. In other words, they have deposits that are liabilities to them and they're holding treasuries as assets to securing those deposits. And what that you're having now is with commercial real estate. Since coronavirus, we have really two problems with commercial real estate. Since coronavirus, the office environment, it's called urban blight, really. We've had a lot of clients, consumers, businesses decide we're not going to work 5 days a week anymore in the urban center. We might not work at all. We might have a remote workforce, or our workforce might be a hybrid workforce, or we only work in the office a couple of days a week. So what this has done is really reduce the need for commercial real estate in America. And as the demand for commercial real estate goes down, the fair market value of that real estate also goes down. The problem is, of the 2.7 trillion commercial real estate market that we have in the United States, almost $1 trillion of that, 800 billion, has to be refinanced in 2024 alone. And these commercial real estate developers have no ability to refinance at a cost of capital that went from 0.25 at Fed funds rate to now 5.25 to 5.5. In other words, the cost of refinancing is going to be so much more dire for these corporations. They can't afford to refinance their commercial real estate at these high rates. They're waiting for the Fed to cut rates. And with rates and inflation still where they are, that is not looking like a very good prospect. What you also have is a bunch of regional banks. The regional banks are the ones that write the commercial real estate because they know the lay of the land locally best. And because they don't have any room to take a haircut, they don't have any room to say, we need to refinance this real estate portfolio that you have with us. And guess what? It's only worth now 85% of what it used to be worth. The actual commercial real estate entity can't come up with that 15% differential. The bank doesn't have the ability to write off 15% because that would put them under. So you can see that you have this banking liquidity crisis happening because a lot of stuff has to be refinanced while banks have tightened their lending standards and rates are still a lot higher. This is a recipe for bank liquidity crisis and more bank failures. And the Federal Reserve themselves have put in a policy document that we should expect more bank failures in 2024. To summarize all of these 7 factors that I'm talking about, while the market might be looking up on positive days, the economy in general, not even to mention the global economy, China has lost $7 trillion of market capitalization in their stock market in 2024. They have returned now, the CCP has returned to stimulus and much more government spending in order to get their economy back. So you've got China collapsing, you've got Germany that is de-industrializing because their source of energy, cheap energy from Russia through the Nord Stream pipeline being disseminated, is no longer viable, and therefore they are no longer economically viable as a manufacturing country, which is the industrialization of Europe and Germany. So you've got Europe that's having massive problems, you've got Asia through China having massive problems, and what comes to China and Asia and Europe will come to America. So listen to all the prognosticators telling you how great the market is. The market is not the economy, and these factors will have their day of reckoning. For more economic information like this, make sure you follow, subscribe, and like for more.